The trade war between the US and China continues to have a significant impact on the US economy. Numerous tariffs and restrictions imposed by the US on Chinese businesses have increased economic risks instead of the desired negative impact on China's progress. Increased tariffs, policy uncertainty, and the realignment of global supply chains have slowed US GDP growth, reduced consumer and business confidence, and increased business costs. These effects have been particularly pronounced in sectors such as agriculture and manufacturing. Increased operating costs have led to higher consumer prices, reduced corporate investment, and increased financial instability. Financial institutions face increased credit risks and potential defaults, especially smaller banks with serious exposure in the affected sectors. In addition, the trade war has triggered shifts in global financial practices, including a move toward de-dollarization, which could pose additional challenges for the US banking industry. The reciprocal escalation of tariffs has resulted in significant economic disruption. By the end of 2019, the US imposed duties on approximately $350 billion worth of Chinese imports, and China retaliated with duties on $100 billion worth of US exports. This raised the cost of imported goods, resulting in higher prices for consumers and higher operating costs for companies relying on imports. According to the study, the tariffs cost the average US household an additional $831 per year. Higher costs and uncertainty have led to lower business investment. Business investment growth slowed to 2.3% in 2019 as companies postponed or scaled back expansion plans. As companies face higher costs and lower profitability, their ability to repay loans is reduced, increasing the likelihood of defaults. This is especially critical for small banks with serious exposure to commercial loans in sectors hit hardest by the trade war, such as manufacturing and agriculture. The trade war has hurt US agriculture, where farm exports to China declined by nearly 20% between 2017 and 2018, significantly impacting farmers' incomes and ability to service loans. The commercial real estate sector, already under pressure due to high vacancy rates and a shift to remote working, faces additional stress as companies cut back on investment and expansion due to higher costs and reduced demand. The trade war has contributed to the slowdown in economic growth. US GDP growth fell nearly 20% between 2017 and 2018, in part due to a decline in business investment and consumer purchasing power. This economic slowdown could weaken the financial health of banks by reducing loan demand and increasing the likelihood of defaults. The trade war has caused significant swings in financial markets. For example, news events related to the trade war have consistently affected the Chicago Board Options Exchange Volatility Index, BAX, with spikes in implied volatility leading to widening spreads on high-yield bonds and fluctuations in stock prices. A study by the Federal Reserve Bank of Boston found that news of the trade war increased spreads on high-yield bonds by up to 34 basis points in 2018 and 13 basis points in 2019. The trade war caused significant yield curve fluctuations in 2019, contributing to a flattening yield curve and movements in the S&P 500 index. Banks typically hold a mix of investments, including government securities and corporate bonds. Volatility caused by a trade war could lead to large swings in the value of these assets. Higher tariffs on imported goods increase production costs for businesses, leading to lower profitability and potentially higher default rates on corporate bonds held in banks' portfolios. In addition, the increased supply of imported products in the economy has led to lower yield rates on government bonds. Higher costs and uncertainty may lead to lower consumer confidence and reduced borrowing, further undermining the financial stability of banks. The trade war has increased policy uncertainty, causing many businesses to postpone or reduce capital investments. The World Bank estimates that by the end of 2019, the trade war has reduced investment growth in the US by 0.3 percentage points, and expectations for further reductions remain. This slowdown in business investment could dampen economic growth by reducing demand for credit and increasing the likelihood of loan defaults, particularly affecting smaller banks with less diversified portfolios. Uncertainty due to the trade war has undermined consumer and business confidence. Companies facing higher costs and an uncertain outlook are less likely to invest in expansion, which could lead to reduced borrowing. Consumers, fearing potential economic instability, may reduce some of their investments. The trade war has created significant uncertainty for companies with global production networks. Escalating tariffs, regulatory burdens, and other non-tariff barriers have forced companies to adapt their supply chains, often moving production facilities or purchasing from alternative countries. For example, the U.S. raised tariffs on $350 billion worth of Chinese imports, forcing companies to shift production elsewhere to avoid these costs. This has increased operating costs and complexity, disrupting financial planning and stability for businesses dependent on global supply chains. Banks with substantial debt in sectors severely affected by the trade war, such as manufacturing and technology, may experience increased credit risk. The National Bureau of Economic Research noted that companies with export dependence on China have experienced declines in revenues, profits, and capital stocks since the start of the trade war. This increased financial stress in companies could lead to higher loan default rates, directly impacting the financial health of banks with significant loan portfolios in these sectors. U.S. farmers and manufacturers have been hit hard by the trade war with China, which in turn has affected the financial stability of banks, especially small and regional banks. For farmers, the trade war has severely affected U.S. agricultural exports, especially soybeans and pork, whose sales to China have declined significantly. For example, U.S. soybean exports to China have fallen 80% from the three-year average, leading to a sharp decline in farmer income. The USDA reported that retaliatory tariffs reduced U.S. agricultural exports by $27 billion from mid-2018 through the end of 2019, with soybeans accounting for 71% of the decline. Financial difficulties could lead to higher default rates on loans from regional banks. Farmers in particular have faced significant financial stress, increasing the likelihood of bankruptcies and defaults on agricultural loans. The manufacturing sector was similarly affected, with declining revenues and profitability, further increasing the risk of defaults on commercial loans. Manufacturers faced increased tariffs on Chinese products, which raised production costs. This has led to lower profitability and slower investment. Moody's Analytics estimates that the trade war has cost the U.S. economy nearly 300,000 jobs and reduced real GDP by about 0.3%. The process of de-dollarization, in which countries reduce their reliance on the U.S. dollar for global trade and finance, could severely impact the U.S. banking sector. Countries such as China and Russia are actively advocating for a weakening role for the U.S. dollar, which has already resulted in major financial losses and support for labor unions. However, the U.S. dollar remains one of the most stable currencies in China and the most reliable reserve currency in the world. Therefore, higher returns on dollar investments are now expected in the United States. However, a decline in dollar dominance could undermine the stability of U.S. financial institutions, leading to higher borrowing costs and further narrowing net interest margins. This could add to the financial stress of U.S. banks already struggling with commercial real estate loans and rising interest rates. In closing, I want to thank you for watching this video. We sincerely appreciate you joining us today. If our content has been helpful or inspired you, please consider showing your support by liking and subscribing to stay connected with our community. Your support is very important to us. Wishing you prosperity and well-being. See you soon.